Hello investors, welcome to Simpli Stocks. Continuing with our Q3FY26 Results series, in today's video, I will talk about 4 micro-cap or penny businesses from my watch list that have delivered very strong results. But before I begin this discussion, as a standard disclaimer, this video is strictly not a buy or sell recommendation for any of these businesses, and since these are very small companies, you need to be extra cautious with them. Plus, no matter which micro-cap business you are exploring, you have to be overly careful with respect to your allocation as well. Because in micro-caps, as you know, when things go down, they go down very quickly. With that, let's get started. So the first business we will study is Integrated Industries, which has now been renamed to Nurture Well Industries. We have covered Integrated many times in our Simpli Stocks community and on this channel as well. So the stock has recently seen a good rally, but even now I will say it is trading at an attractive valuation and is growing quite well. Let us quickly understand the business model of Integrated in short first, and then we will discuss the results. So Integrated is an FMCG business. It manufactures and sells cookies and biscuits under the Richlite, Fun Treat and Crazy Crunch brand names. The company has a plant in Rajasthan with a capacity of 3,600 tons. Apart from this, it also gets biscuits manufactured through contract manufacturing. Majority of its domestic sales come from North India, mainly Uttar Pradesh, Rajasthan, Uttarakhand, Himachal Pradesh, Punjab and Jammu and Kashmir. The company also exports biscuits to Middle East countries like UAE and Kuwait and to various African countries as well. The exported biscuits are sourced on a contract basis from Malaysia. Exports contribute nearly 80% of total sales, while India business contributes only 20%. So here you have to acknowledge this gap in this business model, that a large part of sales comes from exports and that too largely from Africa. Because of this, Integrated may not receive the kind of premium valuation that other FMCG players like Mrs. Bector's get. However, the management has a clear target to grow the India business as well. 3 years from now, they aim to have a 50-50 contribution from domestic sales as well as export markets. If that happens, it can act as a trigger for PE re-rating in this stock. And apart from the Neemrana plant in Rajasthan, the company was setting up another 5,000 ton plant in Uttar Pradesh. That plant was supposed to become operational by the end of this year, but there has been a delay over there. It will now start next year. So yes, management has made a timeline here, but to balance this, the company is partnering on a contract basis with other manufacturers to ensure that India business continues to grow. Now let us have a look at their results. So Integrated's performance has been quite strong. In Q3, that is the October to December months, sales grew by 46% year on year and profit grew by 88%. Q3 sales reached 290 CR and net profit stood at 35 CR. You can also see margin expansion playing out here. EBITDA margin improved from 8.7% to 11.5%. The company had targeted for 50% sales growth for this year and so far it is well on track. From here, the management is targeting 35% CAGR sales growth for the next 3 years. Currently, EBITDA margins are around 10 to 11%, but they are working towards adding higher margin products as well, like cookies and bakery items to their portfolio. So they will take the margin up to 15%. So along with the strong sales growth, there is also a clear margin expansion trigger playing out here. That means the bottom line growth can be even stronger in Integrated in coming years. However, one key risk here is the export segment. Nearly 80% of sales come from exports and company does not even have its own distribution network over there. It depends on super stockists and large distributors. In fact, just 2 to 3 stockists contribute 50 to 55% of total business. So there is concentration risk here. But see, even if you go about searching with a candle in your hand, you will not find a perfect microcap company. Every company will have some flaws. Microcaps do have some shortcomings, but to compensate for that, earnings growth potential is very solid, and that is why investors flock to microcap companies. My job here is to highlight both positives and negatives for integrated. So this is one risk you have to keep in mind. Now, overall, integrated continues to be a good business. It is also part of my own portfolio. Even at all-time high price, the stock is trading at a PE ratio of 12. Growth is quite strong as the current base is small. And if you compare it with other FMCG players, even small caps like Mrs. Bector's or Zydus Wellness, they all trade at very expensive valuations. So from both growth as well as valuation perspective, integrated appears to be a quite attractive business at this stage. Now, just before moving forward, a humble request. And I know I keep saying this again and again and you don't listen, but if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week, because for us, your likes and subscribes are our only motivation, so that we keep bringing such research to you for free. So do like this video, and yes, also subscribe to our channel. Now, coming back to our discussion, the next business on our list is Tembo Global Industries. Tembo is interesting because we are seeing a transition in its manufacturing mix right now. Earlier, it was mainly in low margin textiles, but now this company is entering into engineering products and solutions, defense and solar segments. Currently, textiles and engineering products both contribute roughly 50-50% to sales, but by FY27, that is next year, textile sales will reduce to 10%. Solar will contribute 10%, defense 20%, and engineering products division will have 60% contribution to sales. In the solar business, the company has acquired land across 24 sites, and the solar plant will start next year. In defense, it has secured a small arms manufacturing license, and machinery installation work has started. Small arms include pistols, revolvers, and rifles. For both the solar and defense segments, Tembo is undertaking a massive investment of almost 1650 crore rupees. Loan for the solar business has already been sanctioned, and loan approval for the defense segment has also been received. So we can clearly see that in a company of just 800 crore rupees market capitalization, capex activity is happening at a very aggressive pace. Now, coming to their largest division now, engineering solutions. The company's new manufacturing plant here has become operational recently. In this segment, Tembo undertakes various EPC projects of these types, which you can see in the photos, across marine, ports, oil and gas, and similar sectors. The iron and steel products used in these projects are manufactured in-house, and the company has recently expanded this capacity significantly. Capacity has increased from 18,000 metric tons to a massive 1,18,000 metric tons. Plus, just like integrated, Tembo also has a clear margin expansion trigger at its Vasai plant. Machinery and production processes are largely automated. Because of this, margins are expected to improve going forward. Firstly, that dependency on labor will be lower, and secondly, automation will enhance operational efficiency. Additionally, the company is planning to enter precision engineering products, which typically command higher margins. So if I summarize all this through this screenshot, we can say that Tembo will effectively have 4 business segments: engineering solutions, textiles, solar, and defense manufacturing. And as per management's estimates, next year around 60% of sales will come from engineering segment, 10% from textiles, 20% from defense, and 10% share will be of solar power. And right here, you can clearly see the margin difference too. Textiles division operates at an EBIT margin of just 2.1%, whereas engineering solutions delivers around 17.5%. So as the company transitions from low margin businesses to high margin business mix, we should see meaningful expansion at the bottom line or net profit level as well going forward. Now, if we look at their recent results, in the December quarter, their sales grew by 50% to almost 250 CR. Profit grew by 37% because of costs incurred due to new capacity, but that is not a problem as of now. That happens. The company has also received several new orders. For instance, the company has received a large 107 crore order from Adani Enterprises. Its total order book has now reached almost 1500 crore rupees, and discussions are ongoing for an additional 700 crore worth of orders. That means if we add the current order book and order pipeline together, we have visibility of orders worth 2200 crore rupees, which provides a strong revenue visibility for the next 2 years. And now with the expanded capacity in place, the company is well positioned to execute these orders efficiently and at better margins also. Tembo Global's management had guided for 1100 crore in sales for this year, which translated into roughly 48 to 50% growth over last year. So far, the company appears well on track to meet this guidance. For next year, management has projected 35 to 40% sales growth along with 10 to 12% net profit margin. So Tembo also looks like an interesting and relatively undervalued business at this stage. It is currently trading at just around 10 to 11 PE. Plus, there are multiple triggers here, from margin expansion to the ramp up in its defense segment. So this is another business that you can study yourself once independently. Now moving ahead, the third microcap business that has announced very strong results is GSM Foils. GSM manufactures such blister foils and aluminium foils which are used as packaging sheets for primary packaging in medicines and capsules, tablets, etc. The company has a customer base of around 65 to 70 pharmaceutical companies for whom it manufactures blister foils and aluminium foils. It is a very small business with a market cap of roughly 300 CR only. You can also see the valuation here. GSM is currently trading at a PE ratio of just 17. But what I really like about GSM is that despite such a small base, the investor communication here is superb. They release results, do con calls, and that too on a quarterly basis despite being an SME. So corporate governance here is very strong. As for the results, in Q3, you will see sales grew by massive 84% year on year, reaching 66 crore rupees. The figures shown here are in lakhs, so please don't get confused. EBITDA margin improved by 70 basis points, or say 0.7%, and at the bottom line level, profit after tax grew even stronger, 96%. In simple terms, we can say that profits have nearly doubled compared to the last year. So from these numbers, we can clearly see that the business is witnessing very healthy growth and is going in a right direction. The company had a manufacturing facility of about 8,000 square feet in Vasai, Maharashtra. Recently, it has commissioned a new plant in Ahmedabad with a carpet area of 17,000 square feet. The target is to ramp up capacity utilization to 50% by March and then reach 100% utilization by next year. And now, apart from these two facilities, the company is also looking for land in Mumbai for setting up third plant. And management has indicated that they will most likely provide an update on this within the next 2 to 3 months. So we can say that we have a very good clarity with respect to GSM's growth plans. So this is another good business that you can study in microcap space. Pharmaceutical packaging is a very large market, and GSM is aggressively expanding capacity and gradually gaining market share. Once the recently commissioned Ahmedabad plant stabilizes, the company also plans to enter the laminates segment. You can think of an ORS sachet packet as an example for laminates. They have better margins. Now, at the current stage, the business is already witnessing strong growth. We are seeing that. And beyond this, the management is preparing to enter into 2 to 3 additional higher margin product categories as well in the short term. Additionally, GSM has plans to migrate from SME to the main board within the next 1 to 2 years. That too can act as an important trigger, as it will improve the liquidity in the stock and also attract a wider set of investors. So this is another business that you can consider studying in detail. The fourth and final microcap from our list is Sejal Glass. Sejal manufactures various types of glasses such as toughened laminated, insulated, decorative, and ceramic. The majority of its business comes from the infrastructure and real estate sector. You must have seen such large glass buildings or premium office spaces. The architectural glass used in those structures is the kind of product Sejal manufactures. Until recently, the company had two manufacturing plants, one in UAE and another one in Silvassa. But recently, they acquired a new business by the name of Plastic Industries, with which they have gotten two new plants in Erode and Taloja. With the facilities in Taloja, Silvassa, and Erode, there is significant scope for growth as these units are at low capacity utilization. So, with higher production, improved capacity utilization, we should see Sejal doing well in the future. Because of the UAE plant, nearly 70% of Sejal's revenue currently comes from outside India. The company had acquired this business in 2022. Prior to that, Sejal was struggling significantly, but after this acquisition, things have improved for them. Now, management estimates that as production in India will go up within the next 2 years, the revenue contribution from India and UAE should be evenly split at 50-50%. Plus, like the other businesses in our watch list, Sejal is also focusing on higher margin products. By the second half of next year, the company plans to manufacture fireproof, bulletproof, and digital print glasses too, which will have better margins. In line with this, if we look at their October to December quarter results, they have been quite strong. Sales grew by 64% year on year. Net profit growth was relatively lower, with net profit increasing 49% compared to the last year. However, that is not a major concern as there was some impact due to implementation of new labor codes too. Demand remains strong in both UAE and Indian markets. Real estate and infrastructure development is progressing rapidly, and we are also seeing the entry of GCCs, which means global companies are setting up offices in UAE and India. So this is also driving healthy commercial demand. Going forward, the management has for now guided for 25% sales growth next year, which appears slightly conservative, I will say, at this stage. However, we will get more clarity or better clarity after their March quarter results. Now, let us pause for a moment here and try to understand what exactly is the trigger in Sejal that makes this business interesting. So as I told you, that company currently has significant idle capacity through which it can scale up production in India and grow revenues. The base is still small, so growth can come at a healthy pace. Plus, since this is a pure manufacturing business, manufacturing setup, fixed costs are relatively high. So as sales will increase, operating leverage can play out here very strongly. In such scenario, expansion at net profit level or say in bottom line will be quite meaningful. In this sector, EBITDA margins typically range between 30 to 35%, whereas Sejal is currently operating at around 17 to 18%. So that clearly indicates there is substantial scope for margin expansion going forward. So you can study Sejal 2 once. Now, if you did not like the video earlier, my humble request, please do it now. And while you are at it, you can also subscribe to my channel, Simpli Stocks. Also, do let me know in the comments which microcap businesses you are currently tracking. If I find any strong business, I can definitely make a detailed video on that as well for all the audience. Rest, I will see you in the next video. Happy investing.